Every major price shock in financial history begins the same way, with a convergence of forces so obvious that everyone sees them coming, yet so violent in their execution that almost everyone gets caught unprepared when they finally arrive. What we're witnessing in silver right now is not just another precious metals rally. It's the final countdown to the most explosive price movement in modern commodity history. And if you own silver, whether physical metal or mining stocks, you have perhaps days, not weeks, before the situation resolves in a way that will redefine precious metals markets for the next decade. The mathematics are brutal. The timing is precise. The forces converging are unstoppable. This isn't speculation. This isn't wishful thinking from precious metals enthusiasts. This is a systematic breakdown of every mechanism that has kept silver prices artificially suppressed for over 40 years, happening simultaneously, creating conditions that no amount of financial engineering can control. And the most dangerous part? Most silver investors have no idea how close we are to the breaking point. The patterns forming right now have appeared exactly twice before in modern history. In 1980, when silver hit $50, and in 2011, when it nearly reached those same levels. Both times, the setup looked impossible until it suddenly became inevitable. This time is different. This time, the physical supply isn't just tight, it's mathematically insufficient. This time, the industrial demand isn't just strong, it's completely inelastic. This time, the paper market manipulation is not just unsustainable, it's facing a delivery crisis that could destroy the entire derivatives-based pricing system. The delivery crisis, when paper promises meet physical reality. The most immediate threat to silver's current pricing structure comes from a delivery crisis that is now just weeks away from potential explosion. Between early and mid-January, in just 7 days, 33.45 million ounces of silver were physically withdrawn for delivery. That meant roughly 26% of COMEX's registered inventory disappeared in a single week. But the real crisis isn't what's already been withdrawn. It's what's coming. The March 2026 COMEX silver contract represents the largest concentration of delivery obligations in the exchange's modern history. Current open interest indicates claims on approximately 600 million ounces of silver, while registered inventories available for delivery contain less than 50 million ounces. This creates a 12.1 ratio of paper claims to physical metal. For context, any ratio above 3.1 historically triggers delivery problems. Above 5.1, exchanges typically declare force majeure. At 12.1, the mathematical impossibility becomes undeniable. A significant portion of what is reported as registered silver is either non-eligible or already encumbered in some way and thus not truly available for delivery. The pool of actually deliverable, fully eligible silver is much smaller than the headline figures suggest. What makes this crisis unprecedented is the behavior we're seeing from contract holders. Instead of rolling positions forward to later months, the normal pattern, traders are demanding immediate delivery, even at premium costs. As the March contract approached its delivery month, an unusual pattern emerged in the futures market. Many traders were no longer willing to calmly wait for March. Instead, they chose to pay up and pull forward their deliveries by several weeks, insisting on taking those silver bars into their own custody as early as possible. This behavior indicates that sophisticated money no longer trusts the exchange's ability to fulfill delivery obligations when the March contract reaches maturity. They're paying premiums to get their metal now, rather than risk being settled in cash at artificial paper prices when the system breaks. The historical pattern. Why this always ends the same way. Understanding what happens when delivery crises reach critical mass requires looking at the only two precedents we have in modern precious metals markets. In January 1980, silver was trading around $16 when the delivery crisis hit the COMEX. Within weeks, silver exploded to $50, a 212% gain in less than 2 months. The crisis was resolved not through additional supply, but through exchange rule changes that effectively eliminated the delivery pressure by forcing cash settlements. In April 2011, silver was trading around $31 when similar delivery pressures emerged. The metal spiked to $49 in a matter of days before exchanges raised margin requirements 5 times in 8 days, crushing the rally through forced liquidation. Both times, the setup was identical: large concentrations of open interest, declining registered inventories, and physical buyers demanding delivery rather than accepting cash settlements. The current situation exceeds both historical precedents in scale and intensity. The ratio of claims to physical metal is higher. The industrial demand creating inelastic buying is stronger. And most critically, the global supply situation is far tighter than in either 1980 or 2011. The silver market remains in a multi-year structural deficit, with demand exceeding mine supply by roughly 160-200 million ounces in 2025. This deficit means that unlike previous crises, which could be resolved through additional supply coming to market, the current delivery crisis is occurring against a backdrop of genuine physical scarcity that cannot be remedied through normal market mechanisms. The China export lockdown, 65% of global supply eliminated. While the delivery crisis builds pressure from the demand side, China's export restrictions have created an unprecedented supply shock that makes resolution through normal channels impossible. China revealed plans to restrict its exports of the shiny metal starting Jan 1, 2026. This isn't just another trade policy adjustment. China processes and refines approximately 65% of the world's silver supply, taking raw concentrate from mines around the world and turning it into the refined metal that industries and investors actually use. The export restrictions mean that roughly 2/3 of global refined silver supply is now locked behind Chinese government licensing requirements that prioritize domestic industrial needs over international market stability. China consumes over half of global industrial silver, primarily for solar panel manufacturing, electric vehicle production, and electronics. But China's strategy goes beyond simply securing their own supply. By controlling exports while maintaining domestic production, they're effectively weaponizing silver as an economic warfare tool, similar to their previous actions with rare earth elements. The immediate effect has been explosive premium expansion in Asian physical markets. Spot silver premiums in Shanghai climbed above 8 per ounce over London prices on December 24th, the widest spread on record, as buyers scrambled for physical metal amid supply constraints. These premiums represent the early stages of what happens when paper pricing loses connection to physical reality. When Chinese buyers are willing to pay $8 premiums over London spot prices, it indicates that London spot prices have become irrelevant to actual supply and demand conditions. The industrial demand explosion, when economics becomes physics. Beyond the delivery crisis and export restrictions, silver faces a demand explosion from industrial applications that operate according to physics rather than economics. The most dramatic new demand category comes from nuclear power expansion driven by AI data center requirements. On 9th January 2026, Meta announced 3 major nuclear power deals totaling 6.6 gigawatts of contracted capacity through 2035. Microsoft, Amazon, and Google signed over 10 gigawatts of long-term nuclear power purchase agreements between 2024 and 2025. These aren't publicity stunts. These are survival strategies for companies that need guaranteed baseload power for AI operations that cannot tolerate grid interruptions. The International Energy Agency's latest projections suggest that by 2030, global data center demand will roughly double to more than 200 gigawatts. The U.S. alone may need 100 to 138 gigawatts of data center capacity, far beyond current supply. Nuclear reactors require silver for critical safety systems, control mechanisms, and electrical components that cannot operate with substitute materials. When nuclear power becomes essential for AI development and energy security, silver demand transitions from price-sensitive industrial use to must-have strategic requirement. By 2026, the auto industry's annual silver use is approaching 90 million ounces, and pure EV penetration is far from peaking. Crossing the 100 million ounce mark is more a matter of time than of debate over direction. Each EV requires significantly more silver than traditional vehicles, particularly in power electronics and charging infrastructure. But the most explosive demand growth comes from solar panel manufacturing, where silver consumption is completely inelastic because no substitute materials can match silver's electrical conductivity properties. The demand for solar energy is expected to remain dominant in the coming years. Silver is essential for photovoltaic cells, with each panel requiring approximately 10 to 20 grams. Global solar capacity already exceeds 1,500 gigawatt and continues to grow at a double-digit pace. As a result, silver consumption will surpass 200 million ounces annually by the end of 2026. When combined, nuclear power expansion, EV production scaling, and solar deployment create silver demand that must be satisfied regardless of price, because these industries cannot function without silver-intensive components. The supply side collapse. Why production cannot respond. While demand explodes across multiple inelastic categories, silver supply faces constraints that make normal market responses impossible. Global silver supply fell from 1.07 billion Oz in 2010 to roughly 1.03 billion Oz in 2024, and remained constrained in 2025. This decline occurs despite silver prices rising substantially, which, under normal supply-demand economics, should trigger increased production. The fact that higher prices haven't generated additional supply reveals structural problems in silver mining that cannot be resolved through market mechanisms. Silver supply is inelastic. Miners cannot flip a switch and bring new supply online. Projects take a decade to develop. Permitting frameworks are clogged, grade profiles are falling, and capital markets aren't funding exploration. Most new projects are likely to face delays and will not come online before 2027. Moreover, the recycling volumes also remain underwhelming, partly due to inefficiencies in recovering silver from high-tech scrap. The inability of supply to respond creates conditions where demand increases, translate directly into price increases, rather than being absorbed through additional production. But the supply situation is worse than simple production constraints. Geopolitical instability in major producing regions is actively reducing available supply. Russia and Mexico, responsible for roughly 20 to 21% of global production, remain geopolitical hotspots. Mining nationalization trends in parts of Latin America create uncertainty for future output. Mexico has become a flat-out no-go zone, and serious money is voting with its feet. Cautious capital is steering clear, and the smartest due diligence step is absurdly simple. Ask whether the world's biggest players are still willing to operate there. When major producing regions become uninvestable due to political risk, the global supply base contracts permanently rather than temporarily, creating structural deficits that persist regardless of price levels. The technical pattern: cup and handle breakout targets, $250, $330. Beyond fundamental supply-demand imbalances, silver's technical structure indicates that we're in the early stages of a price movement that could dwarf previous precious metals bull markets. The breakout from the cup and handle pattern in 2025 is projected to yield a gain of over 700%, similar to the 747% rally from the 1993 low to the $31 peak. If this move is measured from the $30 breakout level, it points to a potential target between $250 and $300. However, the first major hurdle is the psychological $100 level, which could be tested in 2026. The cup and handle pattern represents 40 years of price compression, with silver trading below $50 for over 4 decades, while industrial demand steadily increased and mine supply remained constrained. This multi-decade consolidation formed a classic cup and handle pattern, which silver broke out of in 2025. Moreover, the $31 level has also served as a pivotal barrier, with no yearly closes above it in the past 40 years. The technical breakout above $50 in 2025 represents the end of this 4-decade consolidation period and the beginning of a new pricing regime where silver operates at much higher absolute levels. But the most explosive technical indicator comes from the gold-silver ratio, which suggests that silver is just beginning its outperformance cycle relative to gold. With a 2026 gold target around $5,000 per ounce, if the gold-silver ratio only reverts toward its longer-term band of 55-65.1, silver would be fairly valued around $75-90 per ounce. Yet history has seen brief, extreme bull phases where the ratio compressed to 15-20. Should such an extreme re-rating play out again, silver could in theory trade in the 250-330 range. Extreme ratio compression to 15-20.1 levels has occurred twice in modern history, in 1980 and 2011, both during periods when physical delivery crises coincided with monetary system stress. The institutional awakening, smart money positioning. While retail investors focus on daily price movements, institutional investors are positioning for the structural repricing that fundamental analysis suggests is inevitable. J.P. Morgan Global Research sees silver prices averaging 81 DARM OZ in 2026, more than double its average in 2025. In a note on Sunday, J.P. Morgan analysts said they expected gold to reach $6,300 an ounce, a 30% gain from current prices, by the end of 2026. But J.P. Morgan's public forecasts may understate their private positioning. As the institution that was fined $920 million for precious metals manipulation, J.P. Morgan understands better than anyone how paper markets can be managed, and when physical realities make continued manipulation impossible. The institutional awakening extends beyond traditional precious metals. Investors into technology companies that need silver for operations. Large technology companies are beginning to secure long-term silver supply contracts outside normal commodity markets, bypassing exchanges entirely to ensure access to physical metal regardless of paper price movements. This behavior, direct supply contracting rather than relying on spot markets, indicates that institutional buyers no longer trust normal market mechanisms to provide reliable access to physical silver. The central bank factor, Russia's strategic accumulation. One of the most significant developments involves central bank recognition of silver's strategic value beyond its industrial applications. Central banks remain overwhelmingly gold-focused, but Russia's ongoing multi-year plan to accumulate $535 million in silver is still a watershed moment. The first major central bank to openly add silver to reserves in the modern era. Russia's silver accumulation strategy serves multiple purposes. It provides a monetary asset that cannot be frozen by Western sanctions. It secures supply for domestic industrial needs, and it positions Russia to benefit from the repricing that fundamental analysis suggests is coming. I do think there's an interesting other place where we could think about government stockpiling of critical minerals that is becoming very topical, and more from an industrial standpoint, silver could get folded into that. When governments begin treating silver as a strategic material rather than simply an industrial commodity, it creates additional demand that operates according to national security considerations rather than price sensitivity. Government stockpiling programs, once implemented, tend to be massive in scale and indifferent to market prices, creating demand that must be satisfied regardless of cost. The margin manipulation weapon. Why exchanges are desperate. As fundamental pressures build toward a breaking point, exchanges are deploying increasingly aggressive margin manipulation to prevent delivery demands from overwhelming available physical inventory. The immediate catalyst for the sell-off came from CME Group AID's decision to raise margin requirements on silver futures contracts, effective December 29th. Initial margin for March 2026 silver contracts jumped to $25,000 per contract, a move that forced smaller traders without sufficient capital to close positions or face automatic liquidation. Margin increases during rallies are not market regulation. They are market manipulation designed to protect short sellers and prevent physical delivery demands from reaching levels that would expose inventory inadequacy. The timing of margin increases is never accidental. They occur precisely when delivery pressures reach levels that threaten exchange solvency or when physical premiums begin expanding beyond ranges that maintain paper market authority. But margin manipulation has become less effective because the underlying physical supply crisis cannot be resolved through forced liquidation of paper positions. Silver price collapsed 11% in its steepest single-day plunge since September 2020, hours after touching a record $84.01 per ounce, as traders rushed to book profits following an extraordinary year-end rally. While margin manipulation can create short-term price drops, it cannot create physical silver or reduce industrial demand that must be satisfied regardless of price. Each margin manipulation event actually strengthens the case for physical ownership by demonstrating that paper markets are controlled by regulatory authorities rather than supply and demand fundamentals. The ETF liquidity trap. When redemptions exceed, inventory silver ETFs face their own crisis, as the instruments designed to provide silver exposure may not be able to deliver physical silver when investors demand redemptions. ETFs are creating more demand than there is actual physical metal above ground. And some countries' governments are now promoting these silver ETFs, which are driving up the price of silver futures and silver spot price. ETF silver holdings represent claims on physical metal, but those claims may not be backed by adequate physical inventory when redemption demands spike during market stress. When ETF investors panic and demand redemptions while industrial users compete for the same physical silver, ETFs can face liquidity crises where they cannot obtain physical silver for redemption obligations. This creates conditions where ETFs must either restrict redemptions, breaking their promise to provide silver exposure, or purchase physical silver in markets where premiums may exceed their net asset values. ETF liquidity traps occur when financial instruments promise physical asset exposure, but cannot deliver physical assets when demand spikes. The premium explosion. Physical markets. Decoupling. The clearest evidence that silver's price shock is imminent comes from premium expansion in physical markets that indicates complete decoupling from paper pricing. Physical silver premiums have expanded to levels never seen in modern commodity markets, with some regions reporting premiums exceeding 30% above spot prices. When physical markets consistently trade at substantial premiums to futures markets, it indicates that futures markets have lost pricing authority over actual supply and demand conditions. The Shanghai Gold Exchange closed at $78.49 per ounce that day, nearly $7 higher than COMEX futures. This premium expansion is not temporary volatility. It represents permanent structural change where physical and paper markets operate according to different supply-demand dynamics. The size and persistence of physical premiums indicate that normal arbitrage mechanisms have broken down, creating conditions where two parallel silver markets exist with different pricing structures. The timeline. Days, not weeks. Based on the convergence of delivery pressures, supply constraints, and demand growth, the window for silver's price shock appears to be days rather than weeks. The March 2026 COMEX contract approaches first notice day, when holders must decide whether to demand physical delivery or roll positions forward. Current open interest levels suggest delivery demands that exceed available inventory by massive margins. If delivery demands materialize as expected, exchanges face a choice between declaring force majeure, admitting they cannot fulfill delivery obligations, or allowing silver prices to rise to levels that balance supply and demand through demand destruction. Given the inelastic nature of current industrial demand, demand destruction would require silver prices far above current levels, potentially in the triple-digit range that technical analysis suggests. The timing coincides with Chinese New Year factory shutdowns that reduce short-term physical supply availability, precisely when Western delivery pressures peak. This creates perfect storm conditions where demand spikes while supply contracts, amplifying price pressures that are already building from structural imbalances. The policy response failure, why intervention cannot work. Understanding why silver's price shock appears inevitable requires recognizing why normal policy interventions cannot resolve the underlying problems. Central banks can provide emergency liquidity to prevent institutional failures, but they cannot create physical silver or force other countries to export strategic materials. Regulatory authorities can adjust margin requirements and modify trading rules, but these tools cannot address physical supply shortages that require actual silver for industrial production. China's export restrictions are sovereign policy decisions that cannot be overruled by Western financial regulators or international trade agreements when China prioritizes domestic strategic requirements over international market stability. The inadequacy of policy tools against physical constraints means that silver's repricing must occur through market mechanisms rather than institutional intervention. When policy tools prove inadequate against physical scarcity, markets transition from managed to unmanaged conditions where supply and demand determine outcomes. The historical precedent? Why 200 plus is not speculation silver's potential move to 200 plus. Levels appears extreme until compared to historical precedents during similar supply-demand imbalances. In 1980, silver rose from $16 to $50 in 8 weeks, a 212% gain, when delivery pressures coincided with monetary system stress. Adjusting for inflation, $50 in 1980 equals approximately $180 in 2026 dollars. The current supply-demand imbalance exceeds 1980 conditions in every measurable category. The deficit is larger. Industrial demand is more inelastic, and available inventory ratios are lower. The upper end of analytical projections reflects recognition that current conditions may resolve through extreme price movements rather than gradual adjustments. The preparation window. What silver owners must know. For investors who own silver, the next few days represent the final opportunity to optimize positioning before the price shock resolves market imbalances. Physical silver ownership provides complete protection against delivery crises, ETF failures, and margin manipulation because physical metal cannot be leveraged, hypothecated, or seized through exchange rule changes. Silver mining stocks offer amplified exposure to price movements, but carry additional risks related to operational issues, jurisdictional problems, and management competence that can offset silver price gains. 2026 isn't just another year for silver. It's the year silver mining stocks go vertical. But mining projects located in Mexico are chocked full of risk. Geographic diversification becomes critical for mining stock exposure, with jurisdictional risk potentially determining whether companies can capitalize on higher silver prices. The positioning window is closing because once price movements begin, premiums on physical silver may expand beyond affordable levels for new buyers, and mining stock valuations may gap higher without providing reasonable entry opportunities. The systemic implications? Beyond silver, this price shock will have implications that extend far beyond precious metals markets into the broader financial system. When a major commodity experiences pricing system breakdown, it demonstrates vulnerabilities in derivatives-based pricing mechanisms that govern most modern commodity markets. Silver's experience may preview similar breakdowns in other critical materials that use derivatives-based pricing while facing physical supply constraints. Success in breaking silver's paper pricing system would encourage similar resource nationalism strategies by other countries controlling critical material supplies. The breakdown of commodity derivatives pricing threatens the foundation of modern financial systems that depend on these instruments for risk management and portfolio allocation. The new reality: physical assets versus paper promises. What we're witnessing in silver represents the emergence of a new reality where physical assets and paper promises operate according to fundamentally different rules. My prediction, although I cannot tell the future, is that the price of silver is going to continue to rise in 2026. The price increases reflect not speculation but mathematical necessity, as paper claims on physical assets encounter physical constraints that cannot be resolved through financial engineering. For silver specifically, while nothing is guaranteed, rising economic uncertainty and continued inflation suggest we could see both higher prices and stronger demand in the new year. Rising demand occurs against supply constraints that make normal market responses impossible, creating conditions where price is the only mechanism available to balance supply and demand. The final warning: days, not weeks. Every major financial shock arrives the same way: slowly, then suddenly, predictably, then violently. Silver's fundamentals have been building pressure for years. The technical patterns have been forming for months. The delivery crisis has been developing for weeks. What happens in the next few days will determine whether this pressure releases gradually through managed price increases or explosively through system breakdown that destroys paper market pricing authority. The mathematics suggest explosion rather than gradual adjustment. The historical precedents support violent rather than gentle resolution. The current positioning indicates that smart money expects disruption rather than continuity. If you own silver, you have perhaps days to ensure your positioning is optimal for what appears to be the most significant precious metals repricing event in decades. The countdown has begun, the forces are converging, the window is closing, major move incoming, price shock imminent, preparation time expiring. Physical reality is about to assert dominance over paper promises. Mathematics is about to overrule manipulation. Supply and demand are about to replace exchange control. The silver market is about to remember what it was before derivatives-based pricing made it forget. What happens next will determine whether silver returns to its role as money or continues operating as a manipulated commodity. The next few days will provide the answer. The timer is running, the pressure is building, the shock is coming. Are you ready?